Welcome to the Anton Stetner podcast. And today we're talking about what the Trump administration means for the real estate and economy today and in 2025. So, Anton, let's break it down. What's the first thing that we need to know when it comes to Trump and how it's going to affect our real estate prices and everything related?
Well, Trump's all over the news. I mean, he's everywhere. He's dominating the news right now. And so what I wanted to do is I just went and grabbed, hopefully you're doing this too. You're going to Google, you're dropping in news. We grabbed some top articles. I just want to go through and talk about a few of these articles. And then let's talk about then how it relates to real estate, how it relates to prices, how it relates to taxation, and what we see is going to be the opportunities coming here in 2025.
Awesome. Okay, so the first topic we're going to cover is the Trump name may no longer be a stain on real estate. Some brokers are saying it's night and day in terms of buyer interest. Okay, tell me what's going on here.
You know, Trump Towers, the Trump properties that are in New York, all of a sudden, instead of being stagnant, are having demand. They are selling for more. There's more activity happening around them. And one of the agents in here, she goes as far as saying, I knew they were red, but they wouldn't come out and say it. But now that Trump has won, it's okay to be red. And so there's more people coming out and in their support of Trump. And what was another interesting thing is when you look at his inauguration, you had LVMH there. You had all of the tech bros. You had these heads of state. So with that inauguration, you had all these famous people, these entrepreneurs all show up. So it's not surprising that his real estate assets that they put together, that they sold, are now actually starting to sell for more, rent for more, and have more activity. From your perspective, as a creator and someone who, does a lot of stuff like this, what else do you think that's signaling? Like what are you seeing from your perspective?
Well, I think there's definitely more of an acceptance of the Trump name and MAGA and just what he represents. There's probably almost like a stigma if you were to even say anything positive about him and his administration, what he's saying. Because I remember when he first became president in 2016, of course, I followed Trump for decades because of his real estate. And I remember one particular hotel in Vancouver, BC, got hit really hard when he became president because people didn't agree with his rhetoric and the way he talked. And I think that hotel is not a Trump hotel anymore. The Vancouver one is like a whole different hotel chain. But that was a result of just people literally protesting. So to hear 8 years later that now his real estate is going in the opposite direction is a huge signal. But what I can say for sure, people feel way more comfortable, at least, not necessarily like saying they voted for him, or it's not even as if they did vote for him, just being acknowledging of the fact that he may be a positive effect on parts of the economy versus even just 4 years ago, it was like, if you were a part of a certain camp, you're just anti-Trump anything. And now people are like, hey, let's just, like, this is what I hear the most. Let's see what he does and let's hope for the best.
Yeah.
Which is already night and day difference than like how people used to talk about him before.
Yeah, crazy. In this Curbed article, they even talked about that, how some of the buildings they spent money to remove the name during that time period. And then those properties actually sold for more than the ones who didn't way back in the 2016 to 2020 run. What's interesting, whether you're Republican, Democrat, on a certain level, it's irrelevant. It's this idea that I think people are feeling a little bit more okay expressing their political beliefs, that flow of free speech is a little bit more out there and becoming more acceptable now.
Yeah. So, okay, we talked about how the Trump name, the Trump brand, and obviously Trump real estate is having a positive effect. What about for the regular homeowner? What about for just regular housing? What's like the effect right now?
Yeah. One of the things that, so this was next on our list. It's just the pending home sale indicator from the National Association of Realtors. So from NAR. NAR put out their pending home sales for December, and it was down 5.55%, with the largest drop happening in the West. Okay, so we're here in the Seattle Metro. I have my Mariners hat on and representing Seattle. It's where we live. What do you think Seattle did, my man? Do you think Seattle was up, down, or flat relative to the rest of the nation in December?
I want to say it was down.
Seattle was up
Oh my gosh.
5.5% in December.
So you're saying that real estate prices have gone up more than it was?
No, this is pendings.
Oh, got it.
So we sold more homes in December in the Seattle Metro in 2024 than we did in 2023, while the rest of the nation sold on average 5.5 less. What this is actually showing us is that rates matter. So a couple things. When you go into a presidential election, historically speaking, what happens is that fear of the unknown, the fear of I don't know what's going to happen, takes away home sales. And so home sales slow down naturally. Unfortunately, during that same time period, because you and I were texting about this, the 10-year Treasury went up and interest rates also crested above 7%. And what we know is that rates massively matter. So as rates get near 7%, it's completely unaffordable. As rates start to hit in the low sixes, you start to see the market activity pick up and start to move faster. And that's what happened too. So rates were above 7. We had the election, so it was almost like a double whammy. So this December was slower. Here in the Seattle Metro, it wasn't. Why? Now, I keep telling everyone about this. We even recorded other videos about this. This hidden crisis that we are talking about is the supply crisis in real estate. There's just not enough freaking homes. We haven't built enough. And we haven't built enough since prior to the Great Recession. So every year we're getting a little further behind. And then places like Seattle, places like Portland, places like California, our regulatory burden to actually build them is so high. So it just slows it down, makes it more expensive.
Yeah, and what would you say? I guess it's just too early to know, but has there been an effect from Trump's winning and him being in office on real estate right now? Or are we going to kind of know what the effect is in the months to come?
Yeah, so it's a phenomenal question. It actually depends on where you're at. So in our Seattle Metro, we have high demand because we have so many jobs, so many tech workers. We have such high wages that I would say the demand here is above normal. And then we also live in a very Democratic area. So Washington State itself, even though a lot of the country changed and voted more red, what do you think Washington did?
Also voted a little more red?
We were the only state that voted more blue.
More blue? Really?
Yes.
Oh, shoot. I didn't know that.
Okay. Here's why. We had the COVID lockdowns, stay home. And I forget the exact number, so I'm going to butcher this a little bit, everyone. I apologize. But something like 46,000 people left Washington and then moved to Arizona, Texas, Florida. So let's just call it what it was. The hardcore Republican got all pissed off and they ran away to a Republican state. Then everyone that moved here, and there was like 50, 60,000 people. So I think it was about 100,000 person swing. The people that moved here were even more Democrat. So the state turned more blue. What's interesting though to hear is whether you're Republican or Democrat, there's a belief that the economy is going to improve. So people are buying more homes. So topic number 3, the bidding wars here in the Seattle Metro right now are back. It's crazy. We're trying to represent a first-time homebuyer. We've lost out 5 times. 5 different offers, they have been outbid. All that we're saying is we got first-time homebuyers. They're getting in bidding wars. We're getting in bidding wars in the upper price ranges. And I'm talking 2 million, 2.5 million. And the middle's kind of dead. So it's interesting. The market here in Seattle, and I know this is actually true for a lot of the United States, is very bifurcated, where there's unbelievable demand in the affordable, in the starter, and the first-time homebuyer price range. The middle is more dead. And that upper range where people have felt inflation in a positive effect and positively against their asset column. See, when you own assets, and the value of real estate goes up, or your stock portfolio goes up, you feel rich. So bidding wars at the upper end of the market. So it's like the tale of two markets with a missing middle happening right now.
All right. So with that being said, I think what's going to definitely affect more bidding wars and home prices is the Federal Reserve and rates.
Yes.
Whether it's rate cuts or rates going up. What do you think?
Well, for now, the Federal Reserve has canceled rate cuts. They're like, we're done. And they had their FOMC meeting minutes, and they released them in December. And I will say they were very hawkish. They cut the number of future predicted rate cuts for this year to 2. Papa Powell came out, and prior to him talking yesterday, they released their press release. And in their press release, they removed the talk about making progress towards 2%. So the market yesterday morning felt that was very hawkish. The stock market came down a little bit. Bonds started to move up. I'm like, oh crap, what's happening? So with every Federal Reserve meeting, we sit on bated breath. Benji and I are sometimes making bets and putting them in the book over here as to what's going to happen. And before in my career, we didn't have to watch this, but now we have to watch it because the Fed has all of a sudden become market moving. Interest rates are so sensitive to where we're at.
Well, because house prices are so high. If house prices weren't so high, the rates moving up half a point or up or down wouldn't matter so much. But when you got home prices literally at record highs, it's just it pushes people out of the market that 10 years ago would have been able to afford it no matter what. You know?
That minor change in interest rates, because you're at the second most unaffordable time in history, with, of course, 1980 being the most unaffordable. That quarter point movement, all of a sudden, you're absolutely correct, prevents them from qualifying instantly. All of a sudden, the investor loan no longer makes their debt service coverage ratio. So they realized that they seemed a little bit hawkish. All of a sudden, Papa Powell got up and he was talking dovish. He talked the market back down. You saw the bonds calm back down, which is good. A couple things that I think we have to pay attention to is basically he said, we're making steady progress. They talked about unemployment being good, the economy looking good. I don't know how you feel personally. You know, a lot of people we talk to personally, they feel the economy is not as good as the federal government is reporting. They feel that inflation is much more of a problem than what the federal government is reporting. But what he said was, hey, economy looks good. Unemployment looks good. We can wait. And by them saying we can wait, they're starting this game of chicken with President Trump, with the rest of the world, because we know that instantly he was going to start playing his old playbook, as most politicians do. So it's not just President Trump, because other presidents before have told the Federal Reserve to lower their rates. He's just a little more vocal. And senators have told, on both the Republican and the Democrat side, lower the rates. But because the labor market is so stable right now, they can't. The question, though, that just popped up is, you see that stuff about DeepSeek?
Oh, yeah, about the AI from China?
Yeah.
Yeah.
And then, did you see how the stock market just beat the ever-living crap
got very fearful and sold off, and even crypto sold off. Yes, I did see that.
So, okay, just because that happened as this is happening. So, Jerome Powell's speech is ready to go. What if these AI models no longer are going to cost 600, hundreds of billions, whatever it is, tens of billions of dollars? And because there's so much money in CapEx right now that's being spent. And if DeepSeek proved that you could build one of those for 5 million or 10 million instead of into the billions or hundreds of millions, and we no longer need that spend, is that then going to cause unemployment to rise faster? Is it going to cause people to change their hiring requirements? Because what that is, it's like stacking models on models. They basically use part of ChatGPT, OpenAI, to train that model. So they piggybacked it. But the question is if that's going to happen and we're cutting government jobs and we're cutting government spending, and all of a sudden you've got the private sector, aka a big part of tech, cut major CapEx spending in GPUs, is that enough to push us into a recession where the Fed may be forced to lower rates? That's the crazy thing. That's our unknown wild card that you got to keep watching right now.
What are your thoughts on Trump pushing for rate cuts? I know that it happens with both administrations, but he's obviously very aggressive. Do you think it's a good thing for him to push for rate cuts right now? And of course, as homeowners and buyers, we want lower rates for our mortgages.
And as investors.
Yeah, for sure. But is that a good thing? Because the whole point of the Federal Reserve raising the rates in the first place was to clamp down on inflation, which was kind of like running away a little bit from us.
Inflation was absolutely running away.
Yeah.
It was the proverbial wildfire that had jumped the line, and it was just going to burn over everything. Sorry, I'm not trying to be insensitive to California. I need to point that out there. That's not what we're trying to do there. But I think when he was at Davos, at the World Economic Forum, he really made his position clear. And I'm going to read it specifically. He said, "All demand that interest rates drop immediately, and likewise, they should be dropping all over the world." As he says this to the elite. "I'm also going to ask Saudi Arabia and OPEC to bring down the cost of oil." The fact that he was willing to say that in front of all of these people, crazy. I don't know if I'd have the guts to say that, number one. Number two, he makes a phenomenal point with the globe being a petroleum-based economy. If the cost of oil comes down, everything else gets cheaper. All of our manufacturing, energy production, all of that gets cheaper. So that's phenomenal. That's anti-inflationary. I think what the general public misunderstands is how independent our Federal Reserve is. He can say all he wants till he's blue in the face. Federal Reserve, cut your rates. What does Papa Powell have to do?
What does he have to do if he says it?
Yeah.
He doesn't have to do anything.
He has to do nothing, like zero. He works for an independent branch. He has time left on his term. He has a legacy. He's trying to prove a point. Also, we know he is a little more left-leaning than right-leaning, and that they've butted heads before. So he was ready for this to come up. In the press conference, first question out of the first reporter's mouth, President Trump said you're going to lower rates. What are you going to do? Okay, I'm paraphrasing. He goes, "I have not talked to President Trump, and that's all I'm going to say on it, and just shut it down." And to be honest, I thought he did a phenomenal and professional job there because he did his best to act unbiased, even though he may fully disagree with it. What is happening, though, is around the world, lots of these central banks are already lowering rates, and that our rates are a little bit higher. And it looks like if you take out shelter inflation, because shelter inflation still says it's at like 4.6%. However, if you go look at rents at new data, not the way the federal government calculates it, but at all the new data, most rents are flat or up by like 1%. Some of them are even going down. And we know home prices are not appreciating rapidly. Therefore, if shelter was just in line, we'd already be at the 2%. I believe we've already won the inflation battle. I believe we're headed towards disinflation if the Federal Reserve continues on this track for much longer, where we could actually see some prices drop. So I am slightly more in the Trump camp on this one, not like drop them immediately, but I think the Federal Reserve is going to have to lower them sooner than they're letting on. I think you're going to see more than 2 rate cuts this year. That's my prediction today. Now, that may change based on the totality of the data. I can use the same line that they do. Secondly, we have a lot of commercial debt that is becoming issues. I got a property over there that's a multifamily. Its note is at 4%. I am in the process of refining it right now. Guess what it's going to go to?
6%?
7.75.
Is that really high?
That's doubling the interest
Okay,
rate.
that's crazy.
It's crazy.
That's crazy. What was it before then?
4.
Oh my gosh.
So essentially what's happening there is that used to be a great cash flowing asset. Now it's still a good asset, but the cash flow is going to be shitty.
And that's not just happening to you. That's potentially happening to tons of investors, tons of property owners.
Yes.
And I know this is kind of like out of left field, but in Canada, they have to refinance their homes every like 3 to 5 to 7, 10 years, right? Versus us, homeowners can have a 30-year term. It's fixed. It's good. You don't have to think about it. You're safe, right? So if you locked in at 2 or 3%, you're awesome. Versus if you're Canadians, like, oh, damn, like I have to refinance these. And that's a huge problem.
Yes.
Because this is their primary residence and their income doesn't go up and down with the rates. So when it goes up, so how does that not affect investors and property owners?
It's massively affecting them.
And then, so if that's the case, what's going to happen?
The doomers, what they say is the commercial market is going to crash and it's going to take the rest of the market down. What doomers don't like is they don't like real math. Real math is you can't buy a commercial asset unless you put 25% down. I mean, some of them are 20, but I'd say the majority of commercial assets are between 25 to 35% down. So they have equity inside of them. Or if they're like a big REIT or a real estate syndication, they have LP investor money there as equity. The worst that happens in commercial is that equity gets wiped out and the bank just takes it back and the bank takes no loss. Because that market hasn't dropped 25, 35%. But there's pain happening right now, and this will continue for over the next 2 years. This is buying opportunity as this pain continues to happen and people's debt resets to a much higher rate. See, I only owe like, I want to say that one's 38% loan to value. So, I mean, it's really low. I can afford to have the debt double and it still cash flows. What if you bought $100 million apartment building with investor money? And this is in the news. So all of you can go Google this. You can see examples of this. And you only put 20% down. And then the debt went from 4% to 7.5% or even 7%. It's unsustainable. That's give the keys back. That's game over. So that creates opportunity for us, opportunities for new investors, opportunity for vulture funds to come in, opportunities for bridge debt to come in. So every bad thing creates an opportunity. This isn't the tsunami, but this is a problem. It's also why commercial banks and local banks are tightening up on their lending. Did you hear? So from my Seattle Metro people, did you hear Washington Federal just exited loans?
Entirely?
Entirely. They closed down their loan division. That is the oldest bank in Washington state said no more loans.
Wow.
Why? Okay, I don't know why, so we're speculating. The liquidity is missing in the market and they're not making enough spread, so that division is unprofitable today and they don't want to deal with it and they're very conservative. So remember episodes ago when we talked about this idea of the credit crunch, when there's less lenders and less credit available and things are more expensive. We are in it right now. So the credit crunch creates opportunities for cash investors, opportunities for partnerships, opportunities to go pick things up that are stuck in bad debt, opportunities for private money. I called one of these other local banks and was having a conversation with them. And I was like, dang it, this is expensive. I literally it forced me. I picked up the phone. I called a homie. I said, homie, do you want to be bank on this? And they said, yeah, what are you paying? I said 2 points and 8%. It's cheaper what I'm getting from the bank right now on this one anyway, because it was a construction loan. And they go, I'd love to loan you on that. Boom. I just funded it private off the market and it wasn't one construction loan. It was 5. Most people are not in that situation where they can go through their network. And what happens is the bank will literally just say, give me more down payment. Their origination fees are going up. The spread is going up. So they're asking for more money for the loan, more points on the spread. So in other words, the cost of capital is more expensive and harder to get. And then boom, WaFed exited this week. Crazy times.
Whoa. I feel like that's like the topic most people want to know about because and is that for commercial only or commercial and residential?
I have not done the research, brother. My understanding is they closed down their whole loan department, residential and commercial.
Oh, wow. That's crazy. So then the bigger question is you said there's an opportunity, and I love how you're optimistic all the time. But what is the consequence of that for just the average person that's in that system or relies on this the lending system?
It just got a lot harder for the average borrower. Be prepared to sit in underwriting longer. Be prepared to put more money down. Flip it around. Be prepared to negotiate with the seller harder. Be prepared to get better terms. Right before this, I was just looking at a property, and we said to the owner, hey, the debt's going to be really expensive. So I don't want to buy your property unless you want to give me 10% off. And she goes, well, I don't want to do that. I said, cool, then do you want to be the bank? If you're the bank and you give me a cheaper rate, we can make this work. She goes, I'll do that. She goes, how much you want to put down? I was like, 10%? She goes, deal. And then she goes, how do I know you're going to pay? I said, would you like me to give you a list of all the private debt I currently have that I'm currently paying? She goes, you would do that? I said, I'll give you their phone numbers. You can call the people that I have debt with. And she goes, you're a good guy. I was like, I'm a good guy. My dad grew up as a farmer in Eastern Washington. And he said, do what you say you're going to do and do it right and do a deal on a handshake. And if you can't, don't do it. And she goes, okay, let's do this. So I'm going to, after I'm done here, I'm going to go write up an offer, send it over to her, 10% down, good interest rate, keep the front property as a rental, build a dado or two in the backyard. Let's rock and roll.
But for most people that don't have you as their agent or don't know this, and of course, hey, if you listen to this podcast, you can call Anton or get his assistance. Won't this just make it very difficult and potentially slow the market down?
It's going to slow the market down, but there's so much demand in the Seattle metro, it hasn't hurt our demand. It's hurting our funding. So it's hurting the small to the medium investor. The big boys and girls are going to clean house. And so if you're a small to a medium investor and you can't do it on your own, you got to go find Dear Aunt Tilly. You got to find your best friend. You got to create some type of a partnership or join a syndication or whatever it may be, because like we talked about before, Benji, we are still going through the great asset melt up. It's happening right in front of our eyes. Like, why is the stock market still going up right now? And I realize it had a bad couple days, but just generally speaking, because the government printed too much freaking money and the liquidity has to go somewhere. And the same thing's happening with real estate prices. They're out appreciating what they thought we would because of that amount of liquidity that's still out there.
All right. Do you want to summarize kind of all these points and kind of where we're going to be going the next 3 to 6 months?
One, I'm going to say that there is a level of optimism inside the economy, inside the real estate market, inside the stock market, that is because of the honeymoon period from the Trump administration. If the Trump administration gets some wins and this honeymoon period turns into the momentum period, it could be game on like Donkey Kong. So as I call a bunch of my friends and other hardcore investors and other entrepreneurs, I ask them, how do you feel about 2025? 100% said, it's go time. Okay, so that means they want to play. But if inflation pops up, if interest rates stay too high and don't start to come back down into the mid sixes, if the economy slows down, if so there's a lot of ifs here. If these geopolitical events maybe start to spin out of control, this euphoria, this optimism could wear off like a bad hangover. I'm 68% bull with a little bit of pessimism. And so I'm more than cautiously optimistic right now. So remember last year I was kind of cautiously optimistic. I'm like foot on the gas, making sure we got high octane, but I got a seatbelt on and a helmet and extra cash sitting on the side just in case. And we're watching all the data and we're reporting it to you, our listeners, our subscribers, the people that are hanging out with us, because things could change. It looks like home prices throughout the US are going to appreciate exactly what they did last year and maybe slightly better. Here in the Seattle metro, I'll bet we do slightly better. I thought, and with YouTube, we've got this on record. I thought we were only going to get 5-6%. We ended the year. Doesn't matter where you look. The lowest numbers were 6.5 to almost 10, like 9.7.
Is this nationwide or
no? Just here in the Seattle metro. Yeah. Nationwide, it was like, depending on how you look at the numbers, 2.8 to 3.5.
But still significant.
Still significant.
Highest real estate prices in history, on top of still generally like the
rates.
Results of inflation.
Yes.
Right? Maybe not as much inflation, but what we got inflated to. I can't complain. My steak prices have come down a little bit, but they're still way more expensive than in 2019. So, like all those variables put together, even like a 1 or 2% appreciation in an environment where people are priced out is a big deal, especially here in Seattle. If you're talking 6 to 10%, what's like you just said, like a $2 million house, right?
In Snohomish County, the average price is like $850,000. So 10% would be $85,000. 5% would be $42,500. And that's going to happen in the next year. You can't out-save the appreciation here in our metro. In King County, that average price is 1.1. So 10% would be $110,000. 5% would be $55,000. So between $55,000 to $110,000 more by middle of this year. Because remember, real estate doesn't appreciate evenly throughout the year. Most of the appreciation happens in the freaking spring market. So as soon as the cherry blossoms come out, that's here for the Seattle Metro people. That's the start of our spring market. And then all the appreciation is done by June. So for people who want a deal, there's always seasonality. You got to buy in the winter. You got to buy around a holiday. And if you're going to buy this year, do it now because the bidding wars have already started. And as the weather gets nicer and nicer, the bidding wars will just continue. Now, I know someone in the comments is going to say this. Well, this place in Texas, this place in Florida, I get it. There are 5 metros throughout the United States that are depreciating right now. However, all the rest of them are appreciating. So when we look at the U.S. as a whole, it's appreciating. And why are those ones depreciating? Because they were overbuilt or overmoved to. We're not overbuilt here.
All right. If you guys want to get a hold of Anton, we got all his information down in the description. Any last thoughts for people of how they can get a hold of you or what you're looking forward to helping them with this year?
I'm looking forward this year specifically for helping our first-time home buyers, helping our investors, helping people grow cash flow, create net worth for them, future generations, for their family. As always, you can reach us at rsg.com. 425-249-0214 is our office line. And what I want people to really get out of this in closing, this is today. The data's changing. We're looking every week. There could be something different in a week or two. And when you have questions, drop them in the comments. We're happy to get back to you guys. But we're in a wild time. We're in a historic time, an unprecedented time because the Republican Party has so much control. Whether that's a good thing or a bad thing remains to be seen. I would say most of the sentiment is positive, but we don't know exactly where it's going today. So we got to keep watching. We got to keep figuring this out, and we got to keep asking questions.